Today, we're performing a fundamental stock analysis of Sanofi, ticker symbol SNY. Sanofi is currently trading for $47.74 per share, and over the last year, their stock price is down about 9%. We're performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Sanofi based off of their business fundamentals, to help you determine if it's worth your time and energy to dig deeper into the business. Over the last 5 years, Sanofi is compounding their stock price at a rate of 3.5% annually. Over 10 years, the company's stock price is down 10% overall, so they've declined at 1% annually. And going back prior to the global financial crisis, over the last 18 years, Sanofi's stock price is only up 25% overall, so this is under 1.5% compounded annually. Keep in mind, however, that the company does pay out dividends, and currently Sanofi has an above-average dividend yield of 2.64%. Their average dividend yield throughout this time frame would be in addition to this compounded annual return. Still, the company has underperformed the S&P 500 over the last 2 decades. Sanofi currently is trading between its 52-week high and its 52-week low. The company is down $11 from their 52-week high, and they're up about $10 from their 52-week low. Sanofi is a very large business. They have a 112 billion euro market cap, which is about 120 billion US dollars. For more background about the business, Sanofi develops and markets drugs with a concentration in oncology, immunology, cardiovascular disease, diabetes, and vaccines. However, the company's decision in late 2019 to pull back from the cardiometabolic area will likely reduce the firm's footprint in this large therapeutic area. The company offers a diverse array of drugs, with its highest revenue generator, Dupixent, representing just over 10% of total sales. Profits for Dupixent are shared with Regeneron. About 30% of total revenue comes from the United States, and 25% comes from Europe. Emerging markets represent the majority of the company's remaining revenue. Sanofi was founded in 1973 and is headquartered in Paris, France. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. There are 2 key reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital, so by asking for a benchmark of 14% or higher here, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Sanofi has increased their returns on capital in all 5 of these years. In their most recent fiscal year, the company earned just over 11% return on capital. However, averaged out over this time frame, while their returns are increasing, Sanofi is only averaging about an 8.7% return on capital. So while that's almost a couple percentage points above the returns of a typical business, that's down from our benchmark. So this is an X on metric number 1 for Sanofi. Next, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for revenue, net income, and free cash flow growth over the last 5 years. This metric will be all or nothing in nature. Either all 3 of these will be up for this to be a check, or if even one of these is down, this entire metric will be an X. Over this time, Sanofi has grown their revenues modestly, increasing their revenues by about 19%. Their earnings have grown more quickly. They've grown their earnings by 82%, and the fastest growth of all have come from their free cash flows, which have more than doubled throughout this period. With all 3 of these being up, this is going to be a check on metric number 2. It's great to see that Sanofi's growth was led by their free cash flows, because free cash flow is really the lifeblood of any business, and ultimately a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is what that business will be worth. So a business can use its free cash flows to buy back shares, pay down debt, pay dividends, reinvest back into the business, or make acquisitions. So it's great to see this growth led by their free cash flows. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Sanofi on a per share basis. We're looking for earnings per share growth over the past 5 years for the company. As we just learned, their earnings have grown by 82% over this period. However, we still want to look at what they've done in terms of their shares outstanding. There's not a lot of news around their shares outstanding for Sanofi. The company has basically kept those flat and has marginally diluted existing shareholders by less than 1% over the past 5 years. So their earnings per share are going to be growing almost entirely based based off the back of their earnings growth. This is a check here on metric number 3. Next, for metric number 4, we're looking for something similar. Here we're looking for free cash flow per share growth over the past 5 years. For similar reasons, we're going to have the same result as their earnings per share. Sanofi has more than doubled their free cash flows over the last 5 years, and with this marginal shareholder dilution, the business's cash flows per share have grown. This is another check here on metric number 4, and with this being our third check in a row through our first 4 metrics, we have 3 checks and only 1 X. Then we want to analyze how the business is using debt. So in metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over their last 5 years. So Sanofi has been steadily reducing their net debt position throughout this time frame. They ended their most recent fiscal year with just over $9 billion worth of net debt, and in that same year, the company produced $9.5 billion worth of free cash flow. So they'd be able to pay off their entire net debt position with only 1 year's worth of their current free cash flows. Over these past 5 years, Sanofi has produced $39 billion worth of free cash flow. So this is a very strong check here on metric number 5, as it looks like relative to the debt that the company is employing, the business is strongly cash flow generative. This is great because during economic downturns, it's overly levered businesses that are likely going to be at the greatest risk of poor outcomes. And this wouldn't seem to be the case here for Sanofi, as the company is using a very modest and appropriate amount of leverage in their business relative to their cash flows. This is our 4th check in a row, and through our first 5 metrics, we still only have 1 X on the business. Then the big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may offer a slight risk premium to the yield of the 10-year treasury and may offer a reasonable starting point for a beginning valuation of Sanofi. Before we talk about where the business has been at historically, let's set the stage where the business is currently. Right now, to get a current free cash flow to enterprise value yield for Sanofi, if we divide their $9.5 billion of their most recent fiscal year's worth of free cash flow by their $129 billion total enterprise value, which we're using instead of their market cap because total enterprise value takes into account both their market cap and their net debt position, so it'll give us a perspective of the business that's more similar to as if Sanofi were a private company. So when we divide their $9.5 billion of their last 12 months of free cash flow by their $129 billion total enterprise value, that gives us about a 7.4% current free cash flow to enterprise value yield for the business. So that would be above that risk premium by a couple percentage points. On an average basis, over their last 5 years, Sanofi has produced $39 billion worth of free cash flow, meaning that in an average year, the company is producing about $7.8 billion worth of free cash flow. So dividing their $7.8 billion of their average free cash flow by their $129 billion total enterprise value gives us about a 6% average free cash flow to enterprise value yield for Sanofi. So that's also above that risk premium compared to the 10-year treasury, meaning that metric number 6 is going to be a check here for Sanofi. So the company has the potential to be attractive at today's valuations. In just a couple minutes, we'll use a discounted cash flow model to come to a more concrete estimate of their intrinsic value, but we need to cover a bonus metric first. Also, keep in mind that just because this is a check doesn't mean that you run out and go buy the business. This is not a buy or sell recommendation of any security. As our bonus metric, we're looking at Sanofi's dividend profile. So Sanofi is currently paying out a 2.64% dividend yield, which is better than that of the dividend yield that you'd receive from an S&P 500 ETF currently. However, people make mistakes all the time by blindly chasing dividends, so it's important to stop and look at the underlying fundamentals of a business to see whether their dividends are supported by their free cash flows for Sanofi as a company. Sanofi has supported their dividend payouts in 4 of their last 5 years. From 2018 to 2020, the company had a relatively high dividend payout ratio and they weren't able to support their dividends in 2018. However, since 2020, the business has strongly supported their dividends, paying out just under a 60% dividend payout ratio. So with the company using modest leverage at best, it would seem to be the case that Sanofi's dividends are healthy and in pretty sustainable shape relative to their free cash flows. Keep in mind though that this is not necessarily a guarantee for the future, even though they have looked healthy for 4 of the past 5 years. Then as promised, everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Sanofi, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Sanofi. So a discounted cash flow model is based off the predictability of a business's free cash flows, and it's just like any other model in any other discipline, its outputs will be sensitive to its inputs. So here we're starting with Sanofi's average free cash flows over their past 3 years to give us a more normalized perspective of the business's free cash flows. Then we're using historical growth growth assumptions for how the company has grown these free cash flows dating back all the way until 2000 in order to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions are likely going to be accurate and applicable going forward to give us that baseline projected estimate for Sanofi. If we assume that the business can grow their average free cash flows at a rate of 5% annually for the next 10 years and then 4% annually for the 10 years out after that, then adding in their tangible book value, which gives us an approximation of their tangible net worth. If we were seeking a 15% rate of return, which is the rate of return that Warren Buffett is ideally looking for from his investments in addition to his margin of safety requirements, then it looks like at today's valuations of Sanofi that a potential fair intrinsic value for the business is around $30 per share. So that would be down nearly $18 from their current stock price. There are some factors that you'll want to keep in mind here. One is that this 15% rate of return would be dramatically outpacing how Sanofi has performed over the past 2 decades or so. The company's above average dividend yield would be included in this return, so we would not be doubly counting their dividends. Also, Sanofi has had a low level of predictability in their business in the past, especially compared to some other types of companies, so that may be the case for the business going forward as well. And please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. So in just a minute, we'll talk about our overall rating for Sanofi, but we have to address something first. What are some of the qualitative aspects of this business? Starting with the key qualitative factors supporting a potential long thesis of the company. Number 1, with a wide product offering in vaccines, consumer health, and insulins, Sanofi is well positioned for the fast-growing emerging markets. Number 2, Sanofi's strong entrenchment in rare disease drugs should translate into steady pricing power, as payers tend not to push back on pricing in this area. And number 3, Sanofi is launching immunology drug Dupixent, which holds strong pricing power and major blockbuster potential across several indications. Then for some of the key qualitative aspects of a potential short thesis. Number 1, new vaccine technologies are emerging that could threaten Sanofi's entrenchment in the vaccine market. Number 2, the patent loss on multiple sclerosis drug Aubagio will likely create headwinds to growth in 2023. And number 3, Sanofi's deep entrenchment in China could come under duress as Chinese officials are aggressively reviewing drug marketing practices. So there you have it for a balanced perspective around some of the qualitative aspects of the business. Now it's time for a rating of Sanofi. So in analyzing Sanofi, ticker symbol SNY, we learned that the business earns just slightly above average returns on capital of about 9%, below that benchmark we were looking for. However, the company has grown their revenues, earnings, and free cash flows over the past 5 years, led strongly by free cash flow growth. They've kept their shares outstanding pretty much flat. The business uses a reasonable amount of debt relative to the free cash flows that they're able to generate, and on both a current and an average basis of their free cash flow to their enterprise value yield, it looks like there would be a slight risk premium compared to the yield of the 10-year treasury. Sanofi's dividends have been supported by their free cash flows in 4 of the past 5 years, including their most recent 4 years, and their payout ratio has declined over this time frame. And performing a discounted cash flow analysis of Sanofi, if you've done the work and you believe those historical growth assumptions will be accurate for the future, then it looks like a reasonable fair intrinsic value for Sanofi based off today's valuations of the business if you were seeking a 15% rate of return would be about $30 per share, which it looks like it's been a while since the business was around those levels. That would take us back all the way to August of 2010. So Sanofi checks the box on 5 of our 6 metrics, and it looks like they're a very strong candidate in terms of their attractiveness for further research. So it is worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. Sanofi's been in the news recently for its insulin price reduction, and because the company just made a $2.9 billion acquisition. So there is some shakeup going on at the business more recently, and if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Sanofi with me, and have a great day.